Hello everyone, in this video we're going to be going through the topic of the moving average inventory method. Basically, the moving average inventory method is an inventory cost flow assumption that uses the perpetual inventory system in combination with the weighted average cost of inventory to determine cost of goods sold and value of ending inventory. Okay, after each purchase of inventory, companies must compute a new average unit cost for their inventory. Now this method is not incredibly hard to understand, it's just very computationally intensive. So let's just go through a problem and see what's going on. Okay. XYZ company uses the moving average inventory system to determine the value of its ending inventory and the amount of cost of goods sold to record each year. The company has the following information available for the year ended December 31, 2017 related to its inventory. Then we're just given a bunch of information on dates. Is it a sale or a purchase? The first one is beginning inventory. Then we have the number of units and then the cost of each unit per unit of inventory sold or purchased. Okay, we have a question mark here because we don't know this right now. We actually have to solve for this. Okay, now it says determine the cost of goods sold for the year ended December 31, 2017 and the ending inventory as of December 31, 2017 for XYZ. Okay, so basically January 1, we're starting with beginning inventory, right? So the number of units in inventory is 6,000 units. The cost of those units is $4 a piece, which gives us $24,000 in beginning inventory. And again, we need to do this calculation every time. We need to do the cost per unit. Okay, the cost per unit is the total divided by the number of units, so it's $4 a unit. Here it's very easy, it's very obvious, but we're just gonna do this because every time that we make a sale or a purchase, we have to redetermine our cost per unit, okay? So then we have a sale, okay? We sell 2,000 units, so how many units do we have left? Well, we had 6,000 to start, then we sold 2,000, so we have 4,000 left. What's the balance in the inventory count? Okay, well, it's $4 a unit. Okay, times 4,000 units equals $16,000. What's the cost per unit? Well, it's 16,000 divided by 4,000 units is $4 per unit. So that's our cost per unit. And then our cost of goods sold is going to be what? Well, from before we had, and again, whenever we're making the sales, we're actually not updating the cost per unit. That was when I said before we need to update our cost per unit. It's actually just for the purchases. It's not for the sales. Okay, so the cost of goods sold would be, again, we're using this cost of goods sold from before per unit, so it's $4 per unit times 2,000 sold. That's $8,000 of cost of goods sold. Okay, this should be 4,000 units. It says 400, but it should be 4,000. Okay, then let's see. So that means we have $16,000 of inventory left over, and we recorded $8,000 of cost of goods sold. Then we actually make a purchase. Okay, so in March of 2017, we make a purchase of 4,000 units at $6 a piece. So now we need to determine how many units are in inventory. Okay, well, there were 4,000, right, as of January 30th. Then we purchased 4,000 more, so we have 8,000. Then we need to determine the balance in the inventory count, okay? Well, it'd be the 4,000 from beginning inventory had a cost of $4 a piece. So that was 16,000, right? Then we bought these units at $6 a piece. We bought 4,000 of them. That'd be 24,000. So 24 plus 16 would be 40. Finally, we need to determine our cost per unit. Okay, what's our cost per unit? Well, it's just going to be our total balance in our inventory divided by our total units, which is 40,000 divided by 8,000 units gives us $5 per unit. There's no cost of goods sold here because we don't sell anything. Okay, now we can fill this in. This is $5 a unit because now we know that our next sale is going to be on August 31st, and we're going to be selling the units from the March 31 inventory that are $5 a unit. Okay, so now let's just get both pages in here, make sure we have all the information we need. Number of units so then we sell 5,000 on August 31st. So then how many units do we have? Well, we had 8,000 from March, right? We had 8,000. Then we're subtracting out 5,000 because we're selling those. So we have 3,000 left over, okay? So what's the balance of the inventory count? Well, it's the $5 per unit that we had before because we're not buying any additional units, so the per unit cost is not changing. Okay, times the 3,000 units that are left over, that's $15,000 in our inventory account. Then our cost per unit is $15,000. Again, the total inventory cost divided by the total number of units of 3,000, $5 per unit. Cost of goods sold is the number sold, 5,000 times $5 per unit is 25,000. Finally, we have our December 29th entry, which is our very last entry to make, and then we'll be able to determine our ending numbers. Okay, so now we purchased 4,000 units for $7. So how many units do we have? Well, we had 3,000 from August of 2017. Then we purchased 4,000, so we have 7,000. What's the balance in the inventory count? Well, it's $5 per unit for the August units of 3,000. That's $15,000 bucks. Then we had 4,000 units we purchased for $7 a piece. That'd be 28,000. If we add 15 to 28, we get $43,000 in our inventory account. Then what's our cost per unit? Again, total inventory cost over total units gives us $6.14 per unit. Cost of goods sold here is 0 because we don't sell any. So now we can determine our cost of goods sold and ending inventory. Ending inventory would be $43,000, right? Because that's what we have at the end of the year. Okay, we have $43,000 of ending inventory, right? We just solved for it. We had 7,000 units, 3,000 were priced at $5, 4,000 were priced at $7, okay? Which gives us $43,000. Then we did $43,000 divided by 7,000 units to get $6.14 per unit. This is going to be our new amount going forward, right? So 43,000 units is the same as saying 7,000 units at $6.14 a unit. Then what's our cost of goods sold? Well, we just have to go to our two areas where we actually made a sale, right? So we made a sale on January 30th and August 30th. So again, our cost of goods sold on January 30th was 8,000. Our cost of goods sold on August 31st was 25. So that means our cost of goods sold was $33,000 for the year. Okay, so that's the end of this video. Again, nothing crazy complex here in terms of understanding what to do. It's kind of the same thing over and over again. It's just a lot of calculations, as you can see. Okay, so that is the end of this topic, and I hope that was helpful.